and thank you for joining this latest webinar in our expert series, where we share our industry insights on topical items to help you help your people make the most of their workplace pension and have the best retirement plan. My name is Stuart Hopley. I'm one of the pension experts here at Scottish Widows, and today I'm delighted to be joined by the inimitable Pete Glancy. Many of you may know him as Pensions Pete, and as you may have seen from LinkedIn, he's also got his own merchandise. He's fresh from walking the boards of Westminster to bring you the latest views on pensions policy, and there's a lot going on. We're also today going to be chatting about the Pensions Review, a proposed framework to support all pension scheme members, the Pensions Bill itself, and the impact of bringing pensions into the scope of inheritance tax. You'll see you can ask us your questions too, and there's a team of experts in the background to help you with whatever you want to know. And I'll be able to put some of your questions to Pete too. This session is being recorded and you'll be able to replay it and share with your colleagues in due course. I do have to say that everything you hear today is our commentary on facts and known consultations and absolutely should not be construed as advice. And finally, on my list of things to remember to tell you, do have a look at the resources area of this webinar. There's lots of support items for you to access, including items from our Retire Well catalogue of assets to help promote pensions with your people. So let's get started. Pete, can you kick us off by sharing your latest views on pensions policy, and I'll come back and ask you a few questions along the way.
Thank you very much, Stuart, and good morning to everyone, and thank you for joining us this morning. I just wanted to kick off with a bit of an overview, a bit of context, if you like. We're going through an unprecedented amount of change and forthcoming change at the moment. This slide here sets it out in the simplest way that I can. To give you a bit of background, we've got a new Labour government. They're a year into their term. We have a pensions minister, a chap called Torsten Bell. Now, Torsten is unique in that he is the first minister that we've had who has an office in two government departments. He has a ministerial office in HM Treasury, and he has a ministerial office in the Department for Work and Pensions. The reason for that is that those two departments really don't see eye to eye on anything to do with pensions. They brief against each other through the media, they work against each other, they don't share. And I think it's a sign of the current government's intent that they want to do some fairly big things, and they want to do some fairly radical things, and that they need to get those two departments to work together. So I don't envy Torsten's job, straddling those two camps, but it's certainly a sign of the intent. Not for discussion today, but Torsten's also unique in that he has been given responsibility for pensions tax policy. That didn't used to sit with the pensions minister, so that's maybe something to look out for the future. Two big things in terms of the current government's ethos, if you like, that drive a lot of the detailed thinking. One is, which they've inherited from the previous government under Jeremy Hunt and Rishi Sunak, is that they also believe that pension assets should be playing a much greater role in growing and turbocharging the UK economy, driving GDP growth and helping make people better off, etc. One thing that they have, which is new, is that they very much see pensions not as a pot of money that you can choose to use as you see fit when you reach the age of 55, including passing it on to your dependents. They see it really as a pot of money that's there to provide you with a guaranteed level of income for life. So we will see a lot of policies coming through that start to look at pensions as being an entitlement to an income for life rather than a pot of money. The IHT changes, which we'll touch on, is just the opening salvo in that regard. What I'm going to do as we run through the subjects on the agenda is I'm only going to touch on the things that I think are of most relevance to the audience here today, an employer audience. There's lots going on. I can't possibly give you the detail on absolutely everything. Stuart covered the main things there. I'm going to touch on the pensions review, which is split into two phases. I'm going to touch on the pensions bill and on the IHT element there from the last budget. The only thing on the FCA side, a lot of that's quite technical. A lot of it's to do with modernising UK pensions and investment rules now that we've left the European Union. The only thing I'm going to touch on there is a new facility called Target Support, which will help us engage with pension scheme members more effectively and help them make important and complex decisions. So I'm just going to move on now to the first of the subjects, which is the pensions review phase 1, which is also referred to as the investment review and more often in the media as productive finance. The government was conducting a review second half of last year, which is asking these questions around how should we encourage and enable the UK pensions industry to invest more of British people's pension assets in ways which help turbocharge the growth of the economy. It concluded a few things. The biggest thing that they concluded is that they believe that scale is better. They believe that if we have a smaller number of very large pension providers and pension schemes, that those large schemes and those large default funds will be in a better position to invest in really big things in the UK economy, like infrastructure, or perhaps helping small high-tech businesses choose to grow and expand in the UK rather than doing so abroad. They've introduced a test which says that if you do not have at least £30 billion in your main default fund by the year 2030, you will no longer be able to be an auto-enrolment provider. So you need to have at least one default fund which has that level of scale. You're allowed to continue to have other default funds which are smaller, but you'll be encouraged to merge them into that main default fund over time. And if you want to set up a new default fund, that will become very, very difficult. You'll have to explain to the relevant regulator the extreme circumstances why that's necessary. If you don't get to that 30 billion test, then you will be asked to apply to go into a transitional pathway. You can do that if you have at least £10 billion by the year 2030, and over the next 5 years, you'll still need to get to that sort of 30 billion mark, but you'll also have to demonstrate a number of other things. There'll be more subjective tests for you as a scheme or provider, whether you really have the operational capability and the ways and means of investing at scale. So even if you've got the 10 billion, you might not get there. There's numerous layers. I won't go into the technical detail here. There are numerous layers to the way that pension defaults are constructed. There's a layer which the customer or the scheme member sees, which is also often referred to as lifestyling. There's a number of funds that sit below that, which help people move from higher risk investments when they're younger to lower risk investments, which are less volatile as they get close to retirement. And those funds themselves are often made up of a whole range of funds from asset managers from all over the globe that help pull all of that together. The government is still trying to define the precise definition of that default fund, but it's pretty much going to be a combination of those top two layers. And we believe that in terms of the proposition that we have, we are very well placed across our group personal pension, our group SIP and our master trust. So I'll stop there, Stuart, on that section.
Yeah, I mean, that was what I was going to ask you. Do Scottish widows already meet the scale test? You've kind of alluded to we do, but why do we, particularly if the rules aren't exactly set in stone yet?
The reason that we meet the scale test is that we have the largest and the oldest default fund in the industry. We have 70 billion in our default fund already, which is by far the largest in the industry. These scale tests won't apply at product level. They're going to apply at fund level. So provided that we have a default fund which is bigger than 30 billion, which we do, any of our products which point into that mega fund is the word the government's using, any of our products which point into and use the mega fund are automatically qualifying. So as I say, that's our master trust, our group personal pension, or our group SIP already tick that box. So we're in great shape.
Okay, brilliant. And the next obvious question is what happens then to providers that don't meet the scale test? You alluded to a bit of extra time if they're close, but if they fundamentally don't meet the scale test and don't get approval for extra time, what happens?
It's effectively going to be a point in time at 2030 where you have to apply for reapproval to continue as an auto-enrolment pension scheme provider. And pretty much all pension schemes are auto-enrolment pension schemes these days. You can't not be really. So if you can't meet the scale test, you won't be able to apply for that permission. You won't be able to continue as a provider of auto-enrolment pension schemes. Master trusts or pension providers who are in that position will either need to merge or be taken over by someone else. I think more likely a lot of their clients won't want that decision to be made for them. A lot of the employers who are in those products will be starting to look around and say, well, I want to choose from the best players who are going to survive who I want to be with. I don't think the clients will wait for the master trust to make that decision for them.
Okay. Brilliant. All right. Well, look, let's move on, if that's okay, Pete. Why don't you share with our audience what you're actually going to be talking about later when you're at the Pensions Policy Institute? You've got a round table there on exactly this, the Pensions Commission. So they want to know what you think they should be doing. So share with our audience first.
Right. So the pensions commission. The last one of these that we had was back in the noughties between 2002 and 2006. Lord Adair Turner was running that. And what that did was it took pensions policy out of the hands of the politicians and government, which is necessary in order to get a consensus across employer bodies, trade unions, consumer groups, government departments, all of the various regulators, all of the various parts of the pensions industry, etc. And they came up with, the big thing they came up with, of course, was auto-enrolment. And that was a compromise between lots of the views of all of those different parties. What the new Pensions Commission is going to be asked to do is to look ahead to the year 2050, the middle of the century, and predict what are the challenges that the nation will be facing in terms of retirement planning at that point. What will the demographics look like between working people and retirees? What will the state of the economy be like? You know, how much headroom will the national balance sheet have, household balances, business balance sheets, etc. And what will happen to important factors like housing tenure? Will we have a lot more people carrying mortgages through into their 70s and 80s? Will we have people, a much higher proportion of people carrying private rents? They'll try and look at what that landscape looks like. All of the things that are currently ongoing, all of the things that are in the pensions bill that I'm going to talk about, they will all have happened by around about the year 2030. So what the Pensions Commission will be tasked to doing is saying, once you've got a good feel for the challenge that the nation will be facing out in 2050, what additional and new things do we need to do across government and industry to get the nation into shape? I don't know if it'll be something as big as auto-enrolment. My hunch is there'll be a number of things that are maybe a little bit smaller. Now, the way that we look at this, what we're going to be saying in terms of the inputs to this, there's a whole bunch of major considerations on the right-hand side. We know that there's a massive gender gap that needs to be thought about. There's about 5 million self-employed people that aren't covered by auto-enrolment at the moment. We like the work that Nest Insights and others have been doing on sidecar savings, helping people build up financial resilience for a rainy day alongside building up the retirement savings. So there's a lot of those big questions and big themes on the right there that will be need to considered. But the major learning that we have from the 21 years now of research that we've been doing for our retirement report is that there's really three types of person. I call them the £1-pounders, the £3-pounders, and the no-pounders. Basically, when you're saving for retirement, you're doing that alongside saving for medium-term things, such as getting a deposit to get on the housing ladder, maybe saving up to send the kids to university in a few years. But you're also saving for the short term, rainy days, so if the car breaks down or a roof repair or if the cooker breaks down, etc. The £3-pounders, which is about a third of us, have the money to put into all three of those buckets. But many of us don't know how much to put in each bucket. What's the right amount? What's the most tax efficient way of doing it? What's the right investments to be going into so that that money works hard for us without taking too much risk? So those £3-pounders, they need help in making those sorts of decisions. That's where the challenge lies. The £1-pounders, which is another third or so of us, are people that want to save into all three buckets, but they only have £1. They can only afford to save into one bucket. And this is where flexibility in our system is going to come in. You know, ideas like the sidecar savings, a mechanism that allows you to save for a rainy day and for retirement. And then we have the no-pounders, people who would like to save for those goals, but their household balance sheets just don't have the headroom to save anything at all. And what we need to do there is we need to help people create more headroom in their balance sheets. An example that we have within the wider Lloyds Banking Group is that we have an ambition to build 1 million new social homes. That could 3, 4, 5 million people living in housing where the average cost of a social rent is £500 a month, less than the average private rent. That's 3 or 4 million people we could pull out of poverty to a great extent. And the great thing about investing in things like that is that the rents from social houses are exactly the income streams we need to pay out annuities, so it all becomes quite circular. That's what we'll be saying, Stuart.
Definitely. I mean, Pete, I can't walk past your mention of auto-enrolment. We've had this funny piece of legislation that actually allows auto-enrolment now to come from age 18 and include the first pound of earnings. So when will that actually be enacted?
Yeah, I think that came from the 2017 review of auto-enrolments, and there's still no sign of that being enacted. I think where we are is that businesses just don't have the headroom on their balance sheets, and also individuals don't have the household finances. We saw the reactions from the business community, the CBI, the Federation of Small Business, to the changes to national insurance. We can see that businesses are just really struggling from a balance sheet perspective. Government's sensitive to that, which is why they're not going to put an additional burden on them at the moment. I think that those questions will be handed to the Pensions Commission to consider. I'll be able to confirm that this afternoon when I meet one of the commissioners. But I think that will then be on the output of their work. They will come up with a roadmap of the things that they want to see, and those two changes will be on that roadmap somewhere. But I suspect it will be after the next general election when we see those two things happening.
I can feel the sigh of relief from any finance director right now, Pete, but obviously from outcomes for pension scheme members, there's a bit of sadness there, because certainly 8% is not necessarily enough. And I know Guy Opperman, when he was in the role, he had the same sentiment that you just expressed there. So, I mean, look, there's this phase 2 piece, Pete. What's the potential timings here? When do you think they'll be delivered?
So, we know that they're not going to be able to make any recommendations that have effect before the next general election. I suspect there's a bit of politics in there, and some of these recommendations might be a little bit unpopular in some constituencies, and the government doesn't want to take the electoral risk. But also, as we'll see from the work on the pensions bill, there is an absolutely jam-packed agenda for pension providers, for employers, for the industry in general between now and 2030. So the Pensions Commission is currently being briefed by government officials. They're going to reach out to the industry, which will include employer bodies as well as people like ourselves, later in the summer, maybe September, October time, and saying this is the way in which you can engage with us. They will likely run for about 18 months, so until around about the end of 2026. And I expect that in early 2027, we will see a report from them with a series of recommendations. The government is not saying what those recommendations should be, but one of the constraints on the Pensions Commission is that they can't have anything that needs to be implemented before the next general election. We've got to be given the time to implement all of the stuff from the pensions bill before anything new comes along.
Okay, so overwhelmingly not before the next general election, Pete. And a couple of live questions that have come in. I think you've answered Caroline's. Nice to see you on the call, Caroline. How will this impact employers if a provider doesn't meet the minimum standards? So I think you've covered that, and thankfully, Caroline, you're with Scottish Widows, so that's not an issue. Sonia has asked, Pete, just for a bit of explanation, you mentioned CDC. I know what you're talking about there, but can you just give a two-minute explanation of CDC, please?
So CDC is a concept. It's not just a concept. It's a type of pension scheme that's designed to sit halfway between defined benefit and defined contribution. So it behaves a bit like defined contribution in that it's a percentage of your salary that goes in, but it behaves a bit like defined benefit in terms of the money when it comes out. I think of it a bit like a variable annuity product. So you're getting an income for life in the same way you would do in a DB scheme and a DC scheme. Where it differs from those is that you're in a big collective pot of money of people who are retired and people who are still working. And if the actuaries that are managing that foresee that there isn't enough money in the scheme to keep paying out the current level of benefits in retirement, then you could see a reduction in your level of benefits in retirement, which you would obviously see in a DB scheme or with an annuity. So it's a halfway house. Government would probably like to see the DB schemes that still exist in the private sector. They would like to move some of the private sector people onto that type of scheme. We're not sensing through our research any appetite from employers who have gone to DC to go into reverse gear and start to go back to something that looks a bit more like DB again. So it's a very intellectual concept. I think it'll be probably a bit of a niche for a few specialist groups of employers, but we're keeping an eye on it.
Brilliant. All right, I'm hearing pooling, collective. If it helps, Sonia, sounds a bit like with profits coming back almost. Pete, let's move on again. So lots of change, lots of people might need some support off the back of it. And we know that the FCA and Treasury, they're very keen that people are supported. So what's the proposed framework here?
So the way in terms of supporting people is something called targeted support. So just by way of introduction, at the moment, we have quite a polarised setup for helping people make those complicated and important decisions. At one end of the spectrum, we're allowed to do something called guidance, where we as experts can throw as much technical and expert information as people as we possibly can, and we can do it as intuitively as we can. But at the end of the day, the pension scheme member, the employee, has to make their own decision, their own choice. The other end of the spectrum is if you're lucky enough to be able to afford the services of a professional financial advisor, they will give you a very detailed and personal recommendation based on a massive amount of information that they collect and all of the expertise that they've acquired. But the entry cost for that is about £2,000, and it goes up from there. Only the top 20% or so of the population can afford those sorts of services and support. The other 80% of employees and pension scheme members are telling us that they want an expert to help them make those important decisions, but they can't afford to pay thousands of pounds. One of the things we are doing internally is that we're looking at using technology to greatly bring down the cost of advice. That's something we're doing as a firm. We'll share more about that in due course. But the big thing that the government's doing is it wants us to be able to move away from just throwing information at people and allowing them to make up their own mind, to actually making a suggestion to them, which I think is what a lot of people really want. This new suggestion-based regime is called targeted support. And the way it works is that for each major decision that people might be facing into, there's probably a range of things that they could do. So at retirement, for example, very crudely, you could be taking an annuity, you could be using income drawdown, you could be using a combination of the two. That's a very, very simplistic. So let's say you've got three things you could do. There's three cohorts of people. The way that targeted support would work is we identify the scenario that we're going to speak to people about. In that example, it was helping people decide what to do with their pension pot. We then have a look to see what data do we have on that individual, on our records, on our systems. Usually that won't be enough. We will then construct a digital conversation with that customer to acquire some more information about what they want to do. From the information that we have and the information that you acquire through that digital conversation, we will then be able to put that pension scheme member into a cohort, and based on which cohort they are in, we will be able to suggest the most appropriate course of action for them. Now, there won't be any charge for this. It will be available if you are a pension scheme member. With Scottish Widows, we will provide that service. There is no charge. It needs to be differentiated from personalised advice, for which there will continue to be a charge. And so the real difference here is that you will be getting a suggestion based on the cohort that you are in, whereas with personal advice, which must carry a charge, you will get a very personalised recommendation on your specific circumstances and your specific personal plans for the future. This will be a new permission from the FCA. They will only grant that permission to firms which have the ways and means of doing this really, really robustly. So we expect only a small number of very large firms to eventually get this permission. It will be very tightly regulated so that people aren't using this or misusing it to market products inappropriate, etc. But we think it's a fantastic new tool because going forward, we as experts will be able to help people make those complex and important decisions in a more useful manner. Stuart.
Yeah, so reflections here, Pete. We've got the Stronger Nudge to Guidance. That is designed to help people as they're looking to access their pots. So targeted support is going to be for all. Do you see the majority of this coming from providers? Because it feels like if it's something for people that don't know they want it, it's not going to be able to come with a very heavy cost.
Yes, so there's two types of scenario where this could come into play. One would be a proactive scenario. So people like us got lots of data on our book of customers. We might see, for example, we've got tens of thousands of young people who are invested in a cautious fund. And as experts, we might think it'd be worth having a conversation with them to see if they could take on a bit more volatility when they're young and get some more investment upside. That would be a scenario where we as a provider have lots of information. We want to reach out proactively. There's also then reactive scenarios, one that I touched on there, where we've got lots of people coming to us with a decision that they want help with. One of those being that example I used, where people want help understanding what to do with the pot at retirement. Who will provide it? I've done roundtables with IFAs, personal professional advisors, over the last couple of years, been discussing all of this. The IFA community will not go near this. They want to keep their brand associated with that really detailed, personalised advice. They're worried that this targeted support might be seen as a watered-down version of that. They're also very worried that it may confuse their customers, that some people who receive targeted support might think they've had full personalised advice and come back and challenge them on, it maybe wasn't perfect for their particular circumstances. So the IFA community won't go anywhere near this. You will have to have an FCA permission to provide it. So it's possible that we'll see, I don't think we'll see trustees from occupational schemes applying for this permission. They won't want to be dual regulated by the pensions regulator and the FCA. It's possible that fintechs will want to come into this space and provide a digital service. You might see one or two of them doing it. But I think by and large, this is going to be developed and offered by people who already have a personal relationship. In our case, a pension provider. It will be true of ISA and platform providers, but people who have customers that want help making decisions on their personal finances, those are the organisations that are going to develop targeted support.
Okay, all right. I was going to ask you about the place of advisors, but you preempted that, Pete, wonderfully. Thank you. So let's move on. We've looked at the pensions review. We've obviously just then looked at the framework from the Treasury consultation, but we know there's more. What about the pensions bill itself? There's quite a chunky amount in this.
This isn't a massive amount of stuff. But before I get into the 5 main topics that are relevant to the audience here today, I'll maybe just cover the mechanics of this. There are other parts of the pensions bill which I don't have here, which impact on DB schemes and the local government pension schemes, where I don't think we're interested in those today. I'm concentrating on the DC elements that are relevant to employers. But the mechanics of this is that the government needs to obtain from Parliament the powers to take these things forward. They had a window in the summer to introduce a pensions bill. And it might be the only window they get for a number of years. So they hurriedly have put together a draft bill which contains these things. It's going to be another year, potentially more, on some of these items here before we have all of the detail and the government's worked it through. So the government's trying to get enough wording in the bill for Parliament to give the government departments the power to take this forward. Parliament remains sovereign over government. They represent the interests of the people above government. Parliament does not like giving government departments and government ministers carte blanche to then just go off and do what they like. So the race from government is to try and get enough wording in the bill that gives Parliament a feel for the powers that they're giving to government. But a lot of the detailed work, which is the stuff that we're all really interested in, will continue over the next 12 months. The bill itself will take about 12 months to get through Parliament, and the government's hoping that the work they're doing with people like ourselves and the industry trade bodies, employer bodies, etc., that will all have concluded around about the same time next year. And not only will we have a bill, but we'll have a lot of detail on these 5 things. Now, I'm involved in the background, so I'll try and take you through how I think these 5 things are going to pan out. We're going to get a new small pots framework. The government's concerned that we'll have tens of millions of these small pots, which are built up every time someone leaves that job after 6 months or 3 years or 5 years, however long they're with that employer. And that's going to create a huge admin headache for the industry, increasing costs. But it's also going to be problematic for people organising their pensions, particularly at retirement, if you get there and you've got 20 pots littered all over the place. So the idea here is that schemes and providers will be asked, do they want to put themselves forward to be a small pots consolidator? If they do, they'll need to apply, and it will be a new regulatory permission, just like becoming a pension dashboard provider or just like becoming a target support provider. There'll be a new regulatory permission for becoming a small pots provider. If you get that permission, there's probably going to be about 5, 6, 7 of these schemes or providers. You will go onto a central database. When someone leaves their employer, there will be a notification from that employer's administration systems, a pension provider, essentially, to the central ecosystem. And if the pot is below £1,000, what that central ecosystem will do, we'll see, well, do you have an existing pot with one of the registered small pot consolidators? And if you do, your small pot will then automatically be sent off without the individual consent, etc. It will automatically be sent off to whichever consolidator you have the largest pot with. If you don't have a pot with any of those consolidators, it's likely there'll be a merry-go-round type system where you're allocated to one of those providers. None of this will stop people from choosing to consolidate their pots to the platform or pension of choice. It's just that if you don't make any active decisions, these small pots under 1,000 will start to be automatically being consolidated so that we don't have this litter of small pots as people reach retirement. The next one is a new value for money framework. The government wants to do two things. One is it wants to enable employers and others to be able to look at the value for money that their scheme and product is offering, but on a like-for-like basis. At the moment, GPP, GSIP, master trust providers, they do put lots of information out into the public domain, and employee benefits consultants and corporate advisors can take that and interrogate it and offer a view on which one they think is best. But there isn't actually a like-for-like basis of comparing all of this. So this new framework will require us all to put out a whole bunch of information on investment performance, on charges, on service, and on decision-making support and digital support, etc. for scheme members, and we'll be able to compare it on a like-for-like basis. And basically, you'll have to put a red, amber, or green status on your scheme or your product. And if it's red, you'll need to wind up and move the scheme members into something that's green. If you're amber, you'll be given a bit of time to get the thing back to green. So it's a very, very important framework. It will probably, well, it will come in, I think, for master trusts in 2027 and for GPPs and GSIPs. Sorry, they're both coming in 2027 in terms of the data that they're using, and they will start to issue the conclusions of those reviews from 2028. So that's going to shake the market up a fair old bit, I think. They're just working through some of the detail of the metrics that they're going to use. So all of the metrics haven't been agreed, and it'll probably be later this year into early next year before we get that sort of template published in terms of exactly what's going to be compared. Default decumulation. This is another biggie. At the moment, we have something called investment pathways for contract-based schemes, which is a fairly limited conversation, but we basically ask people coming up to retirement, what are you planning to do with your pot? You're going to take an annuity, you're going to cash it all in, you're going to leave it invested, etc. And we help people into at least an investment solution which is appropriate for that. There's nothing similar in the trust-based world at the moment. So the original plan there was to put in something similar in the trust-based world, but it's evolved into something more than that. So the way that this is going to work, it's a new framework whereby all contract-based schemes and all trust-based schemes will need to make a number of changes. This is the bit that kicks in for 27 for the trust-based schemes and 28 for the contract-based schemes. We will need to move away from a form of language that talks about pension pots, and we will need to start to talk to people all through the accumulation phase about building up an entitlement to an income when they retire. We will need to, at various stages in the lead up to retirement, we will need to start talking to people about the various pension freedoms options that they have, the annuity, the drawdown, the tax-free cash, or the drip-feed drawdown, all of these sorts of things. We will nudge people to make a decision on that as they approach retirement age, or maybe a point slightly beyond that. But if people don't make a decision, it will be a requirement for each scheme and each product to have within the scheme a default decumulation arrangement, which people will then be tipped into. And a stipulation from government is that those default decumulation arrangements must offer an income for the whole of someone's life. It goes back to the point that I made up front, that the government wants us to move away from pots of money that people can spend willy-nilly and then run out of that money and then rely on state benefits later in retirement. They want people to be able to provide for themselves as far as possible through the state pension and through their private pensions. So these default decumulation arrangements will need to be underpinned by an income that will be provided for the whole of someone's life. That kind of takes you into annuity territory. They don't use the word annuity because they are hoping that there may be other innovations in the industry. They're not quite sure what those might be. You will still, of course, be able to use all of the pension freedoms if you so choose, but these default accumulation arrangements will kick in. That could have an impact on the industry in that this is going to be really, really difficult and complicated to set up. Not so for us. We already have decumulation arrangements within our workplace products, and obviously we're a huge insurer that provides annuities and other forms of guaranteed type products. But for many types of scheme and provider, that's going to be really, really difficult to put in place. We've then got a fourth facility, something called contract override. So this is really to deal with a legacy of older products. It's really for your information. But we still have products set up by employers in the 80s and 90s. The products don't exist, by and large, those employers don't exist, but we still have former employees of those organisations who are in those older products. We would like to move those former employees into a modern product, which has lower charges, better investment returns, better digital. We write to these people asking if we can move them. Many people, as we all know, don't engage with pensions, and we just don't get their permission to move. So this new facility will allow us, provided that we can demonstrate to the Independent Governance Committee and provided we can demonstrate to the FCA that the move from an old product to a newer product is in the members' interests, we will be able to move those people to something better without requiring each individual's consent to do so. It should be helpful to a lot of people with those older pots. It will reduce the number of old pots in the industry as well, which will help with that fragmentation challenge that I mentioned at the top. And then probably the most controversial element of the pensions bill is a backstop that the government has built in around giving itself the power to direct where pension money is invested. The way that they've constructed this is that this facility to apply to remain as an auto-enrolment pension scheme provider from the year 2030 and beyond, at the moment, it's only based on scale. You just have to demonstrate that you've got £30 billion, and if you tick that box, you're good to go. The government's put a reserve power into the bill, which is saying that if we don't feel there is enough money being invested productively in the UK economy, we may introduce a condition to that application that says that some of that money must be invested in a way which is of use to the UK economy. Now, we're obviously concerned about that. We don't think that government should be directing the way that pensions money is invested. Those pots don't belong to the government. They don't belong to us. They belong to the pension scheme members. And we don't think that other people should be telling pension scheme members how their pension assets should be invested to help boost the UK economy. So there's 5 really big things in there in the pensions bill. I know that's a lot to get through in a short period of time.
Totally, Pete. So I'll just ask you one question, given we are short of time and you've got inheritance tax to cover as well. Has the concept of pot follows member been abandoned? I mean, will this small pots proposal still mean that people will have multiple pots, albeit a minimum maximum of 2? And Joe has asked, will Scottish Widows be a small pots consolidator?
So I'll do the second one first, because that's nice. Yes, we will definitely. We've made that strategic call. We will definitely be a small pots consolidator. So we will apply, and given our scale, I expect will be welcomed into that fold. The pot follows member, pot for life type idea, I think that's gone. The conservative governments tend to lean towards the side of things of personal freedom and choice and empowering people. And they toyed several times of should we partially break the link between employers and auto-enrolment and allow people to pick their own pension provider and just tell their employer who that is. The trade unions hate that idea. They like collective bargaining. They see employers providing a vital role in negotiating a good collective price, if you like, for their employees by doing the negotiation with pension providers on their behalf. That's fundamental to the trade unions' view. So I don't see Pot for Life, Pot Follows Member coming back under a Labour-led government. And I don't think the Pensions Commission will go there either. There's too many other big things which are less controversial that I think they'll focus on.
Okay. All right, Pete, there's so much to ask you, but I'm going to keep moving because I want to make sure there's questions from Jessica, Lynn and Mark about the budget and pension dashboards that I want to ask you at the end. So this next part, I did say there was a lot going on, folks, so I hope you're still with us. This next part is around the inheritance tax piece. So pensions being brought into the scope of inheritance tax when they were previously exempt. So what was the government thinking behind this, Pete, and what are the key details for our audience to take away?
Okay, so there's probably a couple of things in terms of their thinking. One is that they had a black hole, and they still do, and there was an expedient way of raising some money. But I think more fundamentally, it goes back to the comment I had at the top of this session, where alongside the productive finance agenda, the other big continuing theme that we will see is that the government wants to transform the way that pension pots are thought about. They don't see them as a tax-efficient way of saving for the future. That's not their primary purpose, and they're definitely not intended as a tax-efficient way of passing wealth on to the next generation. They want to very much get pensions back to being a vehicle through which you are encouraged to save, to provide yourself with an income all the way through your retirement. And that, again, as I say, is to take pressure off state benefits. They don't want people blowing their pension early in retirement, claiming other in-retirement benefits like housing benefit later on. They would like people to be able to pay a decent proportion of their long-term care costs, as many of us will require that later in life. So that's what they were thinking. They've announced, of course, that pensions will become subject to inheritance tax. There's two elements to that. One is, well, what's that going to mean in terms of people's behaviours? How's that going to change savings habits? And the other element is the operational side, which I'll touch on first. Not only were they making pensions subject to inheritance tax, but their original proposals were that pension schemes and pension providers were going to have to calculate the amount of IHT that was due. Now, this would have turned pension providers kind of into personal representatives. We would need to have got all of the information about all of the other pension schemes and all of the other elements of someone's estate that would have come into the IHT calculations and done all of that work and then settled all the tax that was due and pay out the residue to the estate, etc. It costs us about £30 or £40 at the moment to process a death claim, a retirement claim, a transfer out. It would cost hundreds, if not thousands of pounds to do all of that work. So we and the industry says, look, this won't work. We've been successful in lobbying for that. So the new rules, people are still going to see their pension pot subject to IHT, but it goes back to the current way of doing things, where the personal representatives will be responsible for gathering all of the information and calculating the tax returns, etc. They do have one thing that they're keeping, and that the personal representatives will be able, when they've done all those calcs, to instruct the pension scheme or provider to settle the tax directly with HMRC. It's another one of the things that they've been consulted on. There'll be another consultation launched in September as to how employers, personal representatives, pension schemes, HMRC will all work together to make this happen. Some of these things are only agreed at principle level at the moment. In terms of, well, what's this going to do? We think about, again, three groups of people. We often have three groups of people. We've got a bunch of people who we call first in, never outers. We've got the first in, last outers, and the first in, first outers. The first in, never outers are basically really, really wealthy people. They're putting money into a pension because it's a really tax efficient way of saving, and that doesn't change even with these rules. It's still the most tax efficient vehicle. But those never outers were never planning on using any of that money to help pay for the retirement. They've got so much money, it was just a tax-efficient pot which could be passed on to the next generation really, really tax-efficiently. Now, that's not going to be the case anymore, particularly for those people beyond 75, where you're going to have to pay the inheritance tax and income tax, or potentially double taxation on those pots, and up to 70% of the money might not get passed on. So those really wealthy people are probably going to stop using pensions for that purpose. They will start to gift money onto the next generations and their family. How will they gift it on? Well, pensions remain still the most tax-efficient vehicle on the way in, so they will start to gift money into other people's pensions. So the change in behaviour there is less money into their own pension to pass on. They'll start to gift more money into the generations coming along behind them into their pensions. We've then got another group of people, the first in, last outers. So they've got pension assets and they've got other assets such as savings and investments and ISAs and maybe income from second and third properties or whatever. At the moment, pensions is the last thing you would want to touch because it's the most efficient way of passing money on to the next generation. That's going to change with these new rules. So these people will become first in, first outers, and that they will start to take the money out of their pension, particularly before the age of 75, because if you live beyond 75, the pot will be really aggressively taxed if it's passed on to the next generation. So we'll start to see a much more aggressive drawdown of pensions from people who have lots of other sources of income. And then most people, I think, on this call, most of their workforce will be in this third category, the first in, first outers. These are the people who will rely on their state pension and their private pension to provide their income in retirement. It is most people who are using workplace pensions and auto-enrolment, and there's pretty much no change as far as they're concerned. Stuart?
You've certainly triggered a few questions on inheritance tax, Pete. So I'll try and summarise. I mean, I guess the first thing to ask you about, if we're going to have inheritance tax payable on the full money coming out, gifts to charity still exempt, the current nil rate band, so the threshold for IHT, is that literally going to remain as is?
Don't have the answers to those ones just yet, Stuart. As I say, consultation coming out in September around how all the mechanics of that are going to work in detail. Some of this is still at a principles-based level. I think the big one is the spouses exemption. I should have touched on that. It doesn't matter whether it's a lot of people think about this as a lump sum versus income. It's really there's a spouse's exemption in these benefits, whether it's an annuity or whether it's income drawdown. There's a second life problem. The spouse is still going to get the money in the pension pot to help them see through their retirement without the IHT changes. It's a second life problem. When the spouse passes away, a lot of these changes are going to kick in, to whoever is going to receive the residue after that.
So that answers my other question about spouse's drawdown. So does it create different behaviours in terms of accessing pots?
I don't think so. I think there's initially, when this was published, everyone thought there's going to be a mad rush to annuities. But I think the thinking there was, this is about taxing lump sums, and it's not about taxing incomes. I guess that's true. But it's the second life that this kicks in. So if you're a spouse, there's no impact on the tax treatment from using income drawdown versus annuity. So I think when people work it through, I don't think it's going to change the balances between income drawdown and annuities, away from, of course, inheritance tax at the moment, because long-term interest rates are pretty high at the moment. Annuities are representing about twice as much value as they did 3 or 4 years ago. I'm surprised we're not seeing more use of annuities more generally, but I don't think the IHT thing really impacts on that equation.
I think people are still accessing their pot to buy a Lamborghini, or more commonly a caravan, and all of that. So ultimately, Pete, we don't want these IHT changes to change pension savings behaviours, but we're going to have to look out for that. Okay, well, let's move into our audience questions. Lots of questions from you all. Thank you very much. I think I'm going to have to start, Pete, with what is probably going to now be termed silly season. It seems every year, as we approach the autumn statement, as we approach a budget announcement, there is pensions tax relief, pensions tax-free cash, speculation. It was pretty appalling last year, actually, the speculation, because I think many people, and Mark's commented as a question, many people will have accessed their pot early last year because of such speculation. I saw only yesterday more comment about tax-free cash potentially going. So what say you, Pete, from what you hear in Westminster?
Okay. I'll maybe start off by saying I had a conversation with a journalist a long time ago, and it might have been 15 years ago, from one of the major nationals. Back in these days, people still brought printed papers to a much greater degree. And what they said was that if they put a negative story about pensions on their front page, their circulation would go up by 300,000 copies for that day. It's true in the modern online era with the clickbait. Negative stories that frighten people about pensions drive clicks and they drive revenues. And I think there's a lot of cynical behaviour. There are tens of thousands of people who did silly things with their pension in the run-up to the last budget. What I would say is that you need to kind of read between the lines. The government has published a roadmap of all of the major things that it's going to do between now and 2030, which included a lot of things in the pensions bill, things that are coming out of the first phase of the pensions review. It has said that anything beyond that will be determined by the Pensions Commission. And the Pensions Commission are going to be sitting for another 18 months. Now, I just can't believe that the government would undermine the Pensions Commission by making any major changes to pensions beyond the things that have been published, because that's the remit that the Pensions Commission's got. From the things that are published, you're going to decide everything else that's coming next. I just can't believe that they would undermine the Commission by doing something major. And I think that the industry would be incredulous if they did. Another thing to bring out is that we think about the current government as having a very large majority. That's not the case. The current government is a government that has lots of very small majorities. The vast majority of the MPs are there with just a few hundred votes. And unlike the last time Labour were in power under Brown and Blair, when they were in power, they got the majority of the media on side. Apart from the Daily Mirror, none of the media are on this government's side. So when you combine those two things, doing something negative on pensions that would be incredulous to the industry and to employers and consumer groups and would get them absolutely slated in the media, I just can't see them doing it. So I can't say, I'm not a government spokesperson, I can't say that they won't do something crazy in the budget, but I think we'd all be incredulous if they did something in advance of the Pensions Commission coming out with its findings.
And it's all around trust sentiment, isn't it, Pete? I mean, Melanie's question just now, looking at the record of this current Labour Chancellor already, do you trust this government to take fair decisions regarding the private sector pensions? Are our pensions safe with this government? As I don't hear the same about reforms to the public sector pensions. How are they going to be affected by IHT to their pensions? Is it going to be fair across both pension sectors? I guess that is this pension change, Pete, is it going to also impact public sector pensions?
Well, there's two things in there. I guess, are they making competent decisions, and then is it fair? The country's in a really, really bad place. Living standards have been falling. We've left the EU. There's geopolitical events that we can all see happening that mean we need to restructure. We need to find ways of growing the economy. We're up to our neck in debt as a nation. Our national debt's the size of our GDP. We can't borrow anymore. If we do try and borrow more, the cost of government debt will just go through the roof. So we can't borrow anymore. We can't really tax anymore. We've got the highest tax burden, I think, that we've had in living memory. And you saw the reaction of employers to small increases in taxation there recently. So we can't borrow, we can't tax, but we need to grow and restructure the economy. And pensions and investments money is the only place to go. Now, as I say, the media is against the current government. They will be vilified, whatever they do. They're in a tough spot. They're going to make some tough decisions in the national interest. I think they're looking at these things sensibly. I can't say that everything that they come up with will be popular, but some of them may be necessary. The fairness between the public and private sector, I think that's a reasonable conversation. The Pensions Commission will definitely be looking at that. They'll be looking at the state pension, public sector pensions, private sector pensions. It's a brave thing for a government to do, to say that we're going to give these decisions and recommendations away from the Treasury and the DWP to people who are independent. And I know that one of them is a Labour peer, but the other two are independent academics. It's a brave thing to do, to give that power away. So we've got a good chance of that fairness question being explored. I think it would be a brave government, though, to take on the civil service in terms of reforming those pensions. So, that's getting into politics rather than policy, though.
Indeed. I mean, look, I was going to ask you about state pension, Pete. You mentioned it, so let's go there now. The press has been reporting people losing up to 18,000 in savings due to the reforms. This is potentially the age going up to age 70. I also heard some really good news the other day. Steve Webb reported that actually the gender pensions gap in terms of state pensions closed, which for a company such as us that have been campaigning for 20 years for that, I literally get my pensions engagement season trombone out for it. But I mean, are there any things that people can do to help themselves in terms of the state pension? Is it true that there's a 10-year notice period to make changes to that?
So, as you rightly say, we were doing these pension reports for 21 years now. In the first 10 years of the work that we did, we lobbied very hard for people to be given, women to be given credits when they were taking time out of work, to be carers, bring up kids. We got those changes through. one of the main driving forces, and that's what's addressed a lot of the pensions inequality within the state pension system. So there's still some inequalities dying out in private pensions. In terms of the state pension, we've obviously, alongside the Pensions Commission, the government set up a review of state pension age. So although I said they've been courageous in setting up an independent commission, they didn't quite want to give the commission the power to decide what state pension age should be. That's got massive sort of fiscal and macroeconomic impact. So they've kept that one, but it's going to run in parallel, and the two exercises will be speaking to each other. In terms of top tips for people, a lot of people don't know this. I sound like Michael Caine there without the accent, but a lot of people don't know this, but you need to have worked for at least 10 years to an extent that you've paid enough national insurance over the course of the year to get a credit towards a state pension for that year. You need to have 10 years like that to get any of the new state pension. You need to have 35 of those years to get full state pension. For most people, the state pension will make up the majority of their income in retirement. It won't be their private pension. So if anything, getting those pension credits is more important, even more important than the workplace pension. So if you've got part-time workers and they're just falling shy of the mark where they're paying enough national insurance, get them over the line somehow. That's going to be the biggest thing you can do in terms of making sure they're going to get that full state pension. I'm conscious of time, Stuart, so I'll maybe
stop. Pete, totally. And I've got to ask you one last question. Jessica from our audience has asked it, and we haven't touched on dashboards yet. What is the latest on the pension dashboards?
It's going well behind the scenes. I expect that we will have a public service dashboard next year, and I expect that most, certainly DC schemes, will be pointed into it. It might take a little bit of time to get the response back from the DB schemes. You might be waiting 10 days. It'll get there. But I think we'll have a public sector dashboard next year. Might be a bit clunky initially. I think we'll have private sector dashboards 12 to 18 months after that. They'll be a lot less clunky.
Brilliant. And I know we have connected in the background, which is fantastic news as well. So, Pete, thank you so much. I will give you a rest, sir. And let's, well, that's all we've got time for questions, I'm afraid, folks. Let me just give you a couple of signposts to where you can get some more support. So within our Employer Hub, have a look in the resources area of this webinar programme. You can see the link to it, but it's www.scottishwidows.co.uk/employer. Within that area, you can see lots of support for you as employer sponsors of pension schemes, and you can certainly see the replays of our previous sessions of this expert series, and shortly that's where you'll find the replay of this one as well. There's an area called Retire Well that offers you some support both through email and other campaign material that you can share with your people to build awareness about pensions. And I'm really proud of the team that delivers our Retire Well webinar program, a host of topics through the year. That's where we also can answer questions about pensions from your pension scheme members. And I can't cover this call without talking about my favourite time of year that's coming. I'm not allowed to talk about the celebrity in this year's Pay Your Pension Some Attention campaign. I can confirm it's not Pete Glancy, but you'll see from the campaign who that celebrity is soon. We, of course, at Scottish Widows are going to be literally amplifying our support for pensions during the months of September and October. We're chunking down the sessions for people in to see it, know it and grow it. They're going to be 30-minute sessions, rapid fire across 3 different days and 3 different time slots through the days. And many of the team that's sitting in the background today answering your questions will be there to also answer the questions from your pension scheme members. It just leaves me to say thank you for joining today. Thank you, of course, Pete, for your support and your insight in the session. And once again, thank you to the team that sits behind in the background answering all your questions. We hope you have a lovely rest of your day, and we'll see you again soon. Bye-bye for now.